the challenge is not just related to availability of capital, it is more related to architecture part of it.
What was really missing is the trust layer between the two sides of the marketplace.
The agriculture projects can become attractive only when it is designed as a business.
My name is Countess Ana Debachi. I'm the managing partner at Debachi Capital, which is a family-led investment platform headquartered right now in Dubai, in the UAE. And now we have over 50,000 members that have joined us over the past 6 years. So these are primarily ultra high net worth investors, family offices, venture capitalists, and of course, very talented entrepreneurs, including in the sectors such as agri-tech and food security. So it is a pleasure to join, and I also would love to welcome our panelists, and I believe the introductions were already provided. So we can begin with the discussion. So first, I would like to talk a little bit about the global financing challenge that we're currently facing. So Sunmani, my question for you. So global commitments to climate smart agriculture are growing, but how do you believe we can ensure that climate finance actually reaches smallholder farmers and delivers measurable impact on the ground?
Hi, thank you. I hope I'm audible.
Yes, we can perfectly hear you.
Okay. So this is a very, very important question, and current food system, which is encompassing quite a lot of activities. For example, it includes production, it includes transport, processing, packaging, storage, retail, consumption, and loss and waste management, and it is supporting over 1 billion people across the globe. But at the same time, when it comes to commitment part of it, this climate financing part is growing across, but actually it is very little supporting the smallholder farmers at the ground level. And the challenge is not just related to availability of capital, it is more related to architecture part of it. So to reach the global commitment, the climate finance to farmers, it is very, very important that the whole architecture is woven around local realities. Local realities means the delivering channels of it, the risk sharing part of it, and also how it is reaching the last mile. So it is not just about commitment of the capital, but also deployment of it using different blended instruments, because plain capital won't work. Blended finance is the requirement moving forward with the help of different intermediaries, and also important is to track adoption part of it right from the beginning, and also seeing and managing the outcomes and measuring it at the ground level. So let me substantiate it using one example, because I'm based out of India and I work uh, in Bihar. One of the uh, in terms of human development indicators, it is the state is lagging behind. So with support of Heifer International, our work has demonstrated that finance becomes effective when it is paired with right delivery channels. Women farmers, if they are organized into small groups linked through farmer producer organizations, it gives them access to market, it gives them access to shared resources, and also makes them resilient to different climate shocks. So for climate smart agriculture to work and for global commitments to reach the last mile, I have three submissions. First, we need to work on intermediary channels, make them robust, not just limiting to the available channels, but also looking at channels which are amplifying, which are available at the ground level. For example, farmer producer organization, the cooperatives, the agriculture small and medium enterprises, because they are the real delivery channels, and they are thriving, and they are available at the ground level. Part is measurement part, which I just mentioned about. Measurement should be built right from the beginning. It should not be added later. If it is added later, it won't serve the purpose. And we have options available. We have satellite data available. We have tools to track it at the from the initial level as well. And third, very important part is blended finance component, especially the concessional capital part of it, including the first loss default guarantee, because it can, if this first loss default guarantee is available, it can crowding, or facilitate crowding in of private investors, so that uh, they feel comfortable coming in. Otherwise, without concessional capital and blended finance components, the entire market appears very, very risky. So this is my submission to your question. Thank you.
Thank you, Samani. A question for Ryan. So building on that, where do you believe today's financing ecosystem still falls short, and what structural shifts are needed today to accelerate the resilient food system investment?
Thank you, Anna, and thank you to the Food Security Summit for inviting me today. I appreciate this opportunity to speak to you all. So I spent 25 years working in the investment banking industry, and mostly on the risk and regulatory side. And what that kind of taught me was, how capital moves, but more importantly, sometimes how it doesn't and why it doesn't move. So when I founded Empower back in 2020, and I started spending quite a lot of time on the ground in different communities across Africa, working with local partners, I was quite shocked to find that the issue wasn't really a lack of projects or indeed a lack of capital. There's obviously plenty of capital in the world. What was really missing is the trust layer between the two sides of the marketplace. So the kind of part of the answer to your question is that most impact frameworks are not really designed with those markets in mind. They assume a kind of baseline of data infrastructure, like land registries, continuous connectivity, formal audit trails, that just simply don't exist in many of these communities doing the actual work. We have an example case, a partner we work with in Liberia called SICADI, and that stands for Sustainable Youth Capacity and Agriculture Development Initiatives. And they're doing incredible work in their local community, like flood relief and building climate smart vegetable gardens for the local households. And it's generating a lot of real impact. But the problem is that the format that impact needs to address to an institutional investor is often too high a bar for organizations like that to climb over. So in conclusion, if I had to name one structural shift that I think is pertinent to this issue, is that we need impact verification frameworks that are tuned to the actual conditions these projects operate in, rather than the frameworks that only work in ideal conditions and exclude everyone from the marketplace. I hope that answers the question.
Thank you, Ryan. And Bella, so blended finance is becoming increasingly important, as we know. So from your perspective, how can long-term funding models help build more resilient food systems?
Thank you for having me today, and really pleasure to meet you all. For global investors, the key question is not only yield, it is underwriting risk. So traditional agriculture is difficult to finance because it's exposed to weather, soil pest, labor, variability, water stress, and biological uncertainty. So that makes cash flow hard to predict, quality hard to standardize, and impact hard to verify. So at Uni, we are changing that risk profile. When I say act on, please don't imagine a greenhouse. Imagine a large, white and positive pressure dome on desert land. Outside, there may be extreme heat, dust, past storms, or geopolitical supply shocks. Inside, ag always controls, air humidity, temperature, energy, biosecurity, crop movement, and production protocols in real time by, semiconductor, clean room grade tags. So this is why we call it Agri SBU, a standardized production unit. But the unit alone is not the full business model. On top of that unit, we build an Agri CDMO model. Similar to biopharma CDMOs, Ag Unit produces high-value biological inputs for enterprise clients, food company, health company, K-beauty, ingredient extraction company, beauty brands, and biomaterial companies through long-term offtake contracts. So clients do not need to own the farm. They can contract standardized production capacity. So Ag Unit operates the unit and follows agreed production protocols and verifies the data and delivers a stable supply. Then comes the financial layer. So once production capacity is standardized, contracted, and verified, it can become an investable product. So through digital MRV and blockchain-based RWA infrastructure, we're designing digital farming rights, programmable rights linked to verified production in future yield, carbon value, and operating model and data. So for investors, the bankable asset is not only the crop, it's the full stack, standardized production capacity, enterprise offtake, and verified operating data, carbon value, and eventually tokenized agricultural rights. So to sum up, we're not selling crops first. We're deploying production assurance and turning it into a investable agriculture infrastructure.
Thank you, Bella. And moving on to what makes agriculture actually investable. So Maria, what is, from your experience across more than 20 countries, what makes an agriculture project truly attractive to investors and family offices?
So first of all, hello to everyone, and thanks a lot to the summit for having us in this so interesting panel. And let's go with the question. So I represent a company, Viveros Verón, is a Spanish company with more than 100 years of experience. And from our experience, I can say that the agriculture projects can become attractive only when it is designed as a business. And what is really important, it's not just design on paper, but based on the reality, on the field. And we understand that investors look for the predictable returns, and it's obvious, also controlled risks and long-term sustainability. For us, we have like several key factors, and this obviously could be the right location, the reliable water resources, professional management, very important, but also the market-oriented crop selection and realistic financial model. But above all this, the project must be built on the right genetics and the technical planning from the very beginning. So every decision made before planting will determine the profitability of the orchard for the next decades. And it's very important to understand from the beginning. In our company, and also based always, everything that we share, all the information, all our suggestions are always made based on our experience. And as we can see in these more than 20 countries where we are already working, the successful projects always combine from one side the strong technical expertise, But from the other side, there should be a clear business strategy from day one. So this combination is the match for the for the future success of the project. Thank you.
Thank you, Maria. Bella, so your technology, as you mentioned, so that transforms agricultural infrastructure into bankable financial assets. So what do you believe actually makes a project bankable in the eyes of investors?
I would emphasize the blended finance we need, of course, but I think in many food security projects, too many risks are bundled together: land, capex, technology, operations, and crop risk, market access, blah blah, sort of that. When everything is bundled, private capital, hesitate because it cannot clearly understand who owns which risk. So our model separates those layers. We use a propco in operation cooperates structure. I mean, the propco can be the sovereign fund, a development finance institution, a corporate landowner, a strategic investor, or a local infrastructure partner. They owned the AgDom asset in AgUni as operator corporates. We operate the unit through AgOS and SOPs and digital MRV in offtake-based production contracts. So, but the key is demand. We do not want the repayment logic to depend on the spot market crop sales. This is why AgUni operates as a agri CDMO. It's like a takeoff contract. So we secure enterprise demand first and produce according to contract, and then operate the standardized unit against the demand. So make it, bankable. I think blended finance, de-risks the asset. So agri CDMO de-risks demand, and our OS de-risks operations, and digital MRV de-risks verification. And blockchain-based digital farming rights can eventually create a regulated RWA layer for broader participation. So this directly addresses one of the big barriers in infrastructure finance, mismatch risk expectations between public and private capital. So yeah, I would share with you, all of you guys, the World Economic Forum strategic intelligence briefing also identifies the risk mismatch as a major reason infrastructure investment does not flow efficiently. So our strategy is simple: standardize the unit, separate the risks, and secure demand first, and verify the data, and then allow different types of capital to participate at the right layer. This is how blended finance can move from one of projects to repeatable food security infrastructure.
Thank you, Bella. And Daria, so from the Saudi Arabian perspective, what determines whether an agricultural investment actually succeeds and pays off?
Yeah, thank you very much. First of all, good afternoon, everybody. I'm really impressed to hear about such a different, diverse experience. Honestly, I was expecting that the forum will be focused mostly on the Middle East, but we hear so many different stories from Europe, North, South America. Great, impressive. And I live in Saudi Arabia, but right now I'm in China. So I'm connecting from Shenzhen. This is another completely different agriculture environment with thousands of small farmers, which is extremely different to what we see in the Middle East. And what defines investment project to be successful and being paid off? Well, first of all, I'm a very practical person. So